G'day there. Welcome to the closing bell on the 31st of May for me. And I'm going to look at the S&P 500 because I think there's an interesting little setup on the weekly chart. It's a bearish divergence that's opening up or that's being confirmed, which just hints that there may be short-term weakness coming for the market. But I thought I'd kick off with the monthly because just to make the case that across different time frames the market will look different. So if I say weekly on the weekly, it looks a bit negative. I'm not saying it's negative on the monthly and that it's, everyone's got to run away. So I just want to make that statement really clear that, S&P 500 still up near its all-time high. This is the monthly, long-term uptrend, uh, broken out to a new all-time high. The monthly bars marching higher nicely. Um, big picture, uh, the stock market needs to fall quite a bit further to really get things looking negative. And just a very quick overview of that is that I'd really need to see, and I actually go up close. You've seen that chart before this monthly, you know it well, probably. Just going up into the very short term on this chart. And uh, just so you know, the really big picture view is that prices really need to fail back below that old high from 2021, which is also close to where that 10-month exponential is. So, that's quite a bit lower than where we are now before the big picture starts to look negative. So we've got the, 5,250 around there is where the current market is. And uh, that level is around 4,800. So that's about 400 points away. It's still a long way away before the big picture looks really negative. And that could take months to play out before it really breaks below that level and says, wow, watch out. There could be some big downside coming. So that sort of big picture stuff is a story for another day. What I'm talking about today, though, is the short term. So I just want to, make that uh, difference known straight up. So you're not thinking I'm making some sort of big sweeping statement about markets right now. I'm really looking at the weekly and saying that there's odds that we could see a bit of weakness just in the short term. And that is based on the weekly bearish divergence. And I just wanted to take you through it. It's a good sort of technical, classic sort of way of looking at markets. The signals don't often show up really nicely and give you a really good trade, but every now and again they do. And I just wanted to describe it for you so you could follow along from here and we see what pans out. So first of all, I'm looking at the MACD, which is this indicator here, and that's on the weekly. So what I'm looking at there is the moving average convergence divergence. So what that's saying is, I look at this weekly 10-week exponential, 20-week simple, and we're just looking at the, how far apart are they? How close are they? And the distance between the two gives you a sense of momentum, shifting momentum. And uh, I've then got a moving average. The black line is a moving average of that. Now, it's a custom indicator for me, not the normal MACD calculation, because I use the 10-week exponential moving average versus a 20-week simple, because I believe it gives better and faster signals. So following that along, you can see that if we're thinking of, momentum shifts sort of up and down, often it can be a good indicator of when momentum is turning back up, especially after it's been weak. Looking at those weekly momentum shifts, it's nothing works all the time. That was just before things turned down again. You got another one there. You saw weeks of buying after that. You got another one there. That was the beginning of a nice move to the upside. Another sort of buy signal there before the market rallied nice and strong. So it can be a good indication of shifting momentum and a good sort of early indicator of that. So the reason I look at that is just saying, we know that the weekly trend is up, and it is still up at the moment. So the weekly trend for the S&P, still up, and until it turns down, that can carry on for a long time. We look back here, the uptrend on the weekly chart lasted from early 2020 up to 2022. So, that is a long period of that trend going up. And you'll see it went into a negative momentum a few times there when prices sort of went sideways for a bit there. And, they were rallying, but, not moving that far. So that negative momentum can just be a bit of a hint, though, before things really turn down. So while you've got that uh, negative momentum on the weekly with the signal line below the black line there, um, it's just saying, well, be wary here because the momentum is not strongly up. So it could be in for a bit of weakness. And then you combine that with the RSIs as they are at the moment. And this is where the bearish divergence idea comes in. And that is when prices reach a new high. So if we're looking at this up close, and we can see here over the last few months, prices created a high, sold off, then they've gone to retest that high and they've created a higher high and then turning down rapidly. So that's where we're saying that has gone to a higher level, but on the RSIs, you can see it's lower. So you've got that pointing down. So that's the bearish divergence where you've got higher highs, but you've got weakening momentum. And so that can often be a precursor to a bigger sell-off. And you'll see here, after it's created a new high on the weekly chart, we've got a weekly sell pivot lining up. Now, it's Friday afternoon for me. I don't know where the S&P is going to close, but if we do get a weekly sell pivot, that will just sort of confirm things on this bearish divergence. And we'll see, you can get weekly sell pivots there, which then get negated straight away. So, when the weekly trend's up, they're less impressive, but here's a weekly sell pivot there just before a multiple week, month sell-off. Another weekly sell pivot there before things sold off quite sharply. Weekly sell pivot there before a big sell-off. So, you need a weekly sell pivot before a big sell-off occurs. So the situation, we've got the weekly uptrend still in play. So it's not until you get the weekly downtrend sort of confirmed that you sort of get more bearish. So it's very early. And the point being, if you catch onto these really early and say, right, I think we've got a bearish divergence coming here, weekly sell pivot, I can jump on, and you've got a pretty tight stop loss. So any sort of weekly buy pivot from here, or breaking out above that all-time high, give yourself a little bit of room maybe. But you're saying, I don't need to risk much here to find out if I'm right. So your risk reward can be quite good. So, if you're imagining that's all you need to risk, and, what if the weekly trend starts, we get a bit of a mean reversion, it's already pretty overbought. I mean, we don't know what's going to come, right? Anything could happen. But you're just in a situation where you could get pretty good risk reward getting short around here. I won't be doing anything in my services. It's not really what I do unless I was to hedge current long positions. This is more just for short-term traders and a bit of a educational thing here. Look, I may end up with egg on my face, but just showing you this actual bearish divergence, which is happening right now. And, looking in the past, if we're looking at the RSI's there, prices going to new highs, RSI is weakening off, and then we got the uh, weekly sell pivot there, and then that was pretty much the beginning of a massive sell-off a few years ago. So, they can lead to much bigger sell-offs. So that's where I'm saying the risk reward can be pretty good. If you can get yourself into a position and you're out very quickly if it goes up, and your upside, with the price falling, you're making money. So, look at that. That would have been a huge trade if you'd managed to get onto that. So it's just a short-term signal, the still bullish, long-term, monthly, all still fantastic. This is just saying it's a little weekly signal saying that we may be in for a bit of downside, and uh, that downside may be a couple of weeks, and then go straight back up. That's what can happen. But as long as you had a chance to take part profits during that sell-off, it doesn't matter, does it? Because you create the free call option. You give yourself, or free put option, I guess, if you're short, by taking part profit and then allowing yourself to see what comes next uh, without risking your original capital, which is really the whole game. Um, so that really is about the funnest thing I could find out there right now. It's just, takes a long time for these things to set up, and these good bearish divergence like this, you don't often see them. So despite the fact we've still got a weekly uptrend, I'm just interested to see what comes next here, and just thought I would point it out for you in case you're interested in such things. Also, just to finish off, just wanted to quickly look at those Japanese bonds. So this is the Japanese 10-year bond yield chart, and I've said we just want to keep an eye on it at the moment because those rates really shooting higher. So those bonds selling off, and I was saying, look, it's flirting with 1%, at 1% level, which it got rejected from a few months ago, and it's really busting up through that now. So you can see this is a pretty serious trend that's going on at the moment, isn't it? Really strong and busting out again. And where is the right price for these bonds? They've been held down for years and years by the BOJ. They've now owned a huge bulk of them. Inflation sitting above their target levels, and their interest rates way below the US. So are they going to let this find the right level? Do they do this? Why not? Um, this has been since what, 2011, and those rates being low for so long, just feeding into the carry trades and really feeding into the bull markets worldwide as people borrow in yen and just invest offshore, or Mrs. Watanabe, as she's called, I think. The onshore investors in Japan looking for returns and sending money offshore. So what happens if this really takes off? I guess I don't know the answer really yet, but I'm interested in what happens now that it's busted through 1% and the US yen heading back towards 160 as well. Um, when you look at the very long-term chart of that US yen, that 160 level, uh, which it hasn't breached since what, 1987. So that's a hell of a long time. And this is where the Bank of Japan stepped in around 160 a few weeks ago to push the US dollar back down against the yen. So just, things set up. What happens if it busts up through there? and we see a real collapse in that yen, um, does that start to affect other things out there? So that's about it. The US bonds as well have been selling off. Inflation figures here, looking like they're heading back up again rather than down. So it's still a tricky old situation out there. There's no doubt about that. It's tough going, but just in the short term, looks like we could have a bit of a sell-off, but that doesn't really stop that longer term bullish picture, really, does it? Until prices are much lower. All right, cheers. I'll come back with more next week.